Hi, are you unsure about how pensions in the UK work? Or are you unsure about the different types of pension options that are available to you in the UK? Then you need to watch this video. In this video, I'm going to be talking about the different types of pension options that are available in the UK and how you can improve your savings for your retirement without actually improving your pay through the pension. Get strong. Hello and welcome to the Nimble Nomad. My name is Arjun, and on this channel we talk about the tips, tricks and hacks to survive and thrive in the UK. In this video I'm going to be talking about the UK pensions. It is actually boiling today. It is 34 degrees, so I'm going to try my best to focus on this video. It's really hot. I'll do a separate video probably in the future on UK weather, but this is unusual for this type of a summer in the UK. So let's start with the basics. A pension is basically a scheme which is available to you, which helps you save for your future and your retirement. And it's meant to basically provide you with an income after you retire or basically stop working in a normal job, so you no longer are working, and it's basically for your twilight years, so usually in your 60s or your 70s that you have a pension. Also, pensions typically have favorable tax treatment. So basically apart from typical investments and savings that you have, pensions have specialized tax treatments, which means that you don't get taxed as much as you would if you were basically investing in the capital markets or the stock market essentially. It always makes sense to put some money away into your pension because it will help you in the long term when you want to basically retire or you want to work less, because the pension will provide you with a steady income once you've put this money away. So the way you would do it is through your monthly paychecks. You take a little bit of that monthly paycheck and you just deposit away into your pension, and then when you retire or when you no longer want to work in a full-time job, when you're a lot older, that money will be accessible to you and will not be taxed actually. So the way a pension typically works actually is that the money that you're putting away is being invested into the stock market. It may be through different financial instruments, but basically what's happening is the money that you put in now is invested so that in the 20 or 30 years time that you actually need it, that money grows as you keep on plugging away little by little into your investments through the pension, and once they grow, they provide you with a steady income once you've retired. So a lot of people actually have this hesitation that, I don't want to get in investments, I don't like the stock market. But actually, if you're investing or basically if you're saving into a pension fund, then technically you are investing either directly or indirectly into the stock market. So before we get into the main topics of this video, I just want to clarify that I'm not a financial advisor. Any topics or points that I'm covering on this video is purely based on my own experience and intended to be shared for informational purposes only. So if you're unsure about how pensions work or how you should invest, I would suggest that you should seek professional help in order to do so. So what are the different types of pension options that are available to you in the UK? So basically there are 3 different options available to you in the UK. So the first one is the state pension. Now the state pension is basically a pension that the UK government will pay you once you have reached retirement age. Now historically that retirement age has been 65, but if you're in your 30s or 40s, then you're probably, by the time you reach that retirement age, it's likely to change. I did check this on the UK Gov website, and for me personally, I would retire based on the stats that they currently have. I would be eligible for the UK state pension at the age of 68. So I'll put the link of where you can check where you would be eligible for it in the description below. But it's something that constantly keeps changing depending on when you were born and what the social support system in the UK works out to be. So the way that the UK state pension actually works is that you every month that you get paid, you get taxed. Now the taxation in the UK basically works in two forms. You pay the government tax, and then you have something called as national insurance. Now this national insurance is basically a sort of a tax which basically pays for some of the amenities and benefits that you enjoy as being a resident of the United Kingdom. And one of those is the state pension. Now, so basically, as you basically earn this money every month and year and so on and so forth, you start paying away into this national insurance. Now, once you've completed 10 years of paying into the national insurance, you actually become eligible for the state pension. So when you actually retire at the age of 65, if you're currently working towards that and eligible for it, then basically you can start claiming the state pension. How much you actually get paid by the state pension depends completely on how much you put in. So obviously the more you earn, the more you get taxed, and therefore your national insurance is higher. Therefore you would be contributing a higher amount into the national insurance, and therefore you would be eligible for a higher amount. The total amount that you will be eligible to collect on when you retire will be completely dependent on how much you have contributed during your working life towards the national insurance. There are different numbers obviously associated, obviously on the basis of your own personal circumstances, but if you look it up, the full national basic state pension that's available is £134 per week. Which actually, if you break it down into every month, works out to about £580 a month. Now you may think that that's not too bad, but you have to think about this 30 years from now, probably when you're going to retire. And this actually is not a lot if you've got basically mortgages or any other sort of monthly bills such as council tax, heating and water bills that you need to pay out. Clearly, if £580 is not enough, a lot of people assume that the government is just going to take care of them because they've paid this for this tax every year until they basically retire. There are other means of making sure that you have an income for when you retire, and I will get into this right now. So the second type of pension that's available to you is the UK workplace pension. Now this is a pension pot that is available to you from your workplace, and basically by law in the UK, all employers must provide a option for a pension provided you meet the eligibility criteria set out by the HMRC. So a workplace pension is a pension pot that's basically set up specifically by your employer, and it basically means that any money that you save into this pension pot will be available to you when you retire or reach retirement age. It's also known by different other names such as occupational or work pension, but basically they're all the same things. So in order to be eligible for a workplace pension, you basically need to be classified as a worker. You need to be earning more than £10,000 a year, over the age of 22, and basically working in the UK primarily in order to be eligible for the workplace pension. So the way it works is every month you allocate a certain percentage of the amount that you get paid, and that amount, gross basically before your taxes, gets paid into your pension directly. how much you contribute will be completely dependent on how much percentage you set personally. I mean, basically, as part of workplace pension, there's something called as auto enrollment. This is completely automatically enrolled and set up by your employer, and that amount basically gets deducted tax-free or as a gross. So let's say you're earning £100 without tax, then if you wanted to pay the full £100 into your pension, you would be completely tax sheltered on that amount, and that amount would get paid into your pension. Now, it's important to remember that some employers actually also match or contribute into your pension pot. So as long as you say, okay, I'm going to pay 3% into my pension pot as part of my workplace pension, then some employers will say, well, I'll match that in terms of, if you put 3%, I'll put 3% in it. So there is a bit of matching which goes on as well. So that is completely dependent on your personal circumstances, your contract, and your employer. So usually you can claim your workplace pension by the age of 60. I think the lowest is about 55, after which you can claim it. It's important to remember that, there will be some companies which will say, well, you can pull out that money before the age of 55, but just remember, you will get taxed if you do that. So the final option is a private pension. Now, a private pension is basically, okay, over and above your state pension, your workplace pension, and you decide, okay, there's another pot that I want to create for my own retirement so that I have enough money when I retire, right? This is long term, for when I'm done working and I want a steady income. So basically what you can do is you can set up a separate private pension pot, which is with another pension provider independently, to take money after money has been paid into your bank account and deposited into your pension pot. It's important to remember that any private pension that you set up, you can actually maintain or benefit from tax benefits as well. So let's assume, as an example, that you're getting paid 60 grand. Okay, so you're getting paid £60,000. In the UK, the way it would work is your first £50,000, you would have a basic tax rate of 20% applied to it. That's just how the tax slabs work. And then the remaining £10,000, you would be taxed at 40%, which is a higher tax rate. That's just how taxation works. Now, let's assume that you paid £15,000 out of the £60,000 into your pension pot within the tax year. Okay, so if you did that, basically what you would be able to do is that the £15,000 will be paid in, and therefore you would have basically a net of 45,000 as take home that you're actually earning. So the 10,000 typically that you would have been taxed for, that I mentioned earlier, you can actually claim a tax benefit for it as well. So basically you can go back, you can say that because I'm below the threshold of 50,000, for the 10,000 that I would have typically been taxed for, because I'm paying that money into a pension pot, the 10,000 additional that would have typically been taxed at 40% should actually be taxed at 20%. So you just have to claim it from the HMRC through a self-assessment form. So the concept is the same as workplace in terms of when you can access this money. The earliest that you can access this money is the age of 55. I mean, this is kind of the threshold for any workplace or private pension as current rules apply. Now, the one thing that you must absolutely remember is that every tax year, the maximum amount of money that you can put into your pension pot is, so your workplace or your private pension is £40,000 a year. And basically, if you exceed this, you can dip into previous year or prior year tax pension allowances. So if you've exceeded 40,000, you can go back up to 3 years where you've not utilized the full 40,000 tax allowance and increase that pension pot as well. Also, one more important point to remember is there is a lifetime pension allowance as well. there are specific numbers to it, but it's in the region of £1 million. So if you basically paid more than £1 million into your pension pot, then you would have to pay taxes into it. Obviously, you know, if I did the math, it would take you almost 25 years of hitting £40,000 every year in order to meet that 1 million criteria. So just to keep contextualize that, you know, it's very low likelihood that normal people like you and I will probably reach that threshold. Just an important point to note there, just with the allowances, there are some different factors where the allowance can be lower depending on your pay and your income. I'll put a link of where the criteria are set in the description below, so you can find that from the government website as well. Finally, the most important part, how do I increase my savings without actually increasing my pay? So this is actually a pretty simplistic and quite important concept to understand or grasp, especially if you're in your 20s or early 30s, because basically what happens with a pension is, and pension savings, the way it works is, every time you get paid and you decide you want to contribute into your pension fund, the amount gets deducted without tax. So basically you're not paying any tax on this money and it's going straight into your savings account. So let's assume, for argument's sake, that you're earning about £100, yeah? And usually in the UK, the basic tax rate is about 20%. So on £100, you would get taxed 20%, which would be £20. So if you took that money home, right? So if you said, I want that money and I want to keep it in my bank account, you would end up with £80. And if you said, okay, I'm going to save that money, it would be only £80. But if you put that money away into your pension fund, you would put the full £100 into your pension fund. So basically you're automatically saving £20 from being paid to the government in the form of taxes. So by doing essentially just a simple thing, by increasing the amount of money that you're adding into your pension and investing it in through a pension fund, you've automatically given yourself a bit of a pay rise. Now, the other option is workplace pensions. Now, as I mentioned earlier, basically in some scenarios, and it depends completely with your employer, your employer could possibly match your pension contributions up to a certain percentage or amount. I'll give you the specific example with me. Basically, one of my employers previously that I used to work for was willing to contribute 1.5 times of my contribution up to 12%. So basically, if I contributed 8%, they would contribute 12.5% into basically the pension pot. Now, if I do this on my on my gross salary, that's 20% of my salary basically going straight into my pension fund. And this is a great way of saving money for your own retirement. So I made a big mistake, you know, the first couple of years. I thought, you know, pensions, I'm really hesitant about the stock market. I don't want to invest money in it. I'm really scared whether I'm going to get back what I thought I would invest. Actually, it worked out really well when I started doing it. The money actually just, you know, I maxed it out because I realized I was leaving free money on the table. And once you start paying into it, you're not even seeing this happen in reality because it's just happening in the background. On top of that, this is getting invested into the stock market, so it's automatically growing. So when I left my employer and I checked on the portal, basically the money had grown on its own, and it had grown quite a bit because we've had a bull market over the last 10 years essentially. So it's an important thing that you must ask. If absolutely is critical that if you have and are eligible for a workplace pension, ask your employer, what is it that you're contributing or are willing to? And a lot of employers are actually willing to contribute towards your pension because it gives them tax credits or tax benefits as well, because if they contribute into your pension. So it's really important, because if you don't do it, you're basically leaving free money on the table. And especially if you're trying to save for the nest egg, as I mentioned earlier, even if your employer is not contributing, then well, it's a great way just to put money into your pension pot. So that's it, guys. That's all I wanted to cover in this video. I'd like to get your thoughts on what you think about pensions, whether you're against it or for it, and whether you have specific concerns about pensions and how they work. If you've got any questions, please pop them in the comment section below, and don't forget to smash that like button and hit subscribe. I launch videos every Sunday, as always, and I'll keep coming back to you with new videos. Thanks very much and goodbye.